So let's take some time to talk about one of the worst performing stock in my entire portfolio to date with no close competitor. And it's of course this company called Meituan. So for those of you who have been following, if I actually put both charts side by side, you see that Meituan year-to-date performance is roughly down 32%, while the Hang Seng Index, which is tracking the Hong Kong market, where Meituan is based in as well, is up 28%. So if to combine both together, the delta, or the difference in this case, is close to 60%. And some of you might be scratching your head wondering, what the heck happened to Meituan? Myself included. So if to take a closer look in terms of how Meituan has performed recently, actually over the past 5 days, they are down another 14%. And this very significant decline in a short span of time can be attributed to their earnings release for Q2 of 2025 on the 28th of August, hence the huge drawdown. But I think also a little bit more context for those of you who haven't been following. There is this huge food delivery war back in China today. In my previous video, covering Alibaba's most latest earnings release as well, and a lot of analysts from different banks are posing many questions around the quick commerce, instant commerce arm, and also the food delivery platform Ele.me, and how the competitive dynamics are shaping out between Meituan versus Alibaba versus JD.com. So just to give you a quick executive summary of Meituan's most recent numbers, revenue on the top line actually rose 11.7% year on year. The monthly active users across their platforms exceeded 600 million people and 500 million on the main app itself, with users actually transacting at least once weekly. So this kind of signals some sort of stickiness where they are basically not just boosting numbers with new user acquisition and they are not interacting with the app itself. So Meituan essentially reiterated their leadership in food delivery, and they basically clocked in a new high, surpassing 150 million daily orders in July alone. This instant shopping business, I think there is rapid new adoption of 20 million new users in Q2 alone, and they are seeing strong gross transaction value growth in their 618 event. Furthermore, they discuss a few of their other business verticals as well. For hotel and travel, order volumes actually surged 40% year on year. Some of their new initiatives include the Xiaoxiang supermarket in the groceries business. They expanded nearly 1,000 distribution centers in 20 different cities. And Kita, which is their overseas delivery arm, expanded to 20 different cities in Saudi. They are intending to enter Qatar and preparing for Brazil. Right now, Kita is currently ranked number 1 in their Hong Kong business. And they also position the fact that they currently have a very strong cash position, roughly 171 billion RMB in cash and cash equivalent. And if to translate it to USD, it's roughly $24 billion on their current market cap of roughly $80 billion US dollars. So I think at first glance, when you look at these numbers and just a quick summary, it feels like Meituan is firing on all cylinders, and the different metrics of tracking such platform economies like daily active users, number of daily order volume, and the gross transaction value are all growing very nicely. So what exactly happened? So that's basically just the first part of the story. I only presented to you all the nice figures and the nice numbers. So what's the second part of the story? It's basically an absolute abomination on the bottom line. And what I did was basically help to visualize what Meituan did over the past 16 quarters. And as you can see in the latest quarter, Q2 of 2025, operating profits basically went to zero. Operating margins are also close to zero naturally. And across the board, regardless of what you look at, operating profits, net profits, EBITDA, basically all of them trended towards the royal zero number. So margins are compressed significantly due to the heavy subsidy in the delivery war and a lot of the career incentive to build up the supply side of things. And they also needed to dip into their reserves. And if you were to take a closer look to their earnings transcript and disclosure, most of it actually revolves around the idea of defending, competition, subsidy, incentive, acquisition, so on and so forth. And the worst part, the management team actually issued a warning saying that substantial losses will continue into Q3 of this year and will probably get a lot worse. So then the first question on top of mind for most investors is really the idea around competition. How is it playing out? What's going to happen? What can I expect? And is Meituan even confident emerging as the ultimate winner? So here was what they said. So this is not the first time we face this kind of intense competition. And in the past many years, we grew through competition. And through competition, it had shaped our leading position. And from their perspective, the cohorts of our previous and existing consumers continued to show very strong traction. And the longer they stay with us, the higher loyalty they showed. And in fact, they reiterate again, saying that our team has also demonstrated strong execution capability through various challenges in the past. And to add further emphasis, they did say that based on their own research, comparing it to their industry peers, in this case, I think they're really just talking about Alibaba and JD. Their unit economics advantage or gap has further widened amid the intensified competition during this period. And in a very roundabout way, Meituan is saying that their consistent supply-side cultivation is kind of their true economic mode that's going to withstand any of this short-term or near-term spending and subsidy. And like I've alluded, a lot of all this discussion around competition is a very core central theme in this most recent earnings. And it definitely worries potential or even existing investors. And just by listening to this fairly brief narrative, it definitely doesn't instill confidence. So what I did was to actually look at some of these third-party preliminary assessment to understand the current situation and how it's cultivating. So based on the data from Quest Mobile and Late Post, which are all third-party platforms, and this was what came out from their analysis. So in July, I think Taobao's daily active user was 17% higher year-on-year, Meituan was up 20%, and JD was up 46% year-on-year. So in essence, everybody gained market share. And at first glance, JD seems to be the largest winner. But not forgetting that JD is also operating with one of the smallest base, hence the higher increase. And to further deepen the story, between July and mid-August, the daily active users of Taobao continued to grow significantly, while Meituan started to stabilize, and JD.com actually decreased slightly. So in some sense, they had some difficulty retaining its newly acquired users. So amidst all these competitive pressures, I think the user attention in general is kind of limited. So where are they getting all this new mindshare? So it seems like I think Pinduoduo has seen a significant decrease in daily active users over this period. And Taobao in essence captured some e-commerce users from Pinduoduo as well. But if the bargain hunters are attracted just by pure subsidies alone, it's kind of considered a low quality acquisition, and we don't necessarily want to focus a lot of our attention, spending or investments in this group of customers. So on this side, we are talking a lot about demand stimulation and acquiring of users. What about the supply side, which is acquiring of careers for scale, is also an important goal in trying to scale up this entire instant commerce business. So in April, Meituan had almost 8x the number Alibaba had. But by August, Meituan only had 2.6x more, even though both has increased generally, but Alibaba is really playing a lot of catch up and they are scaling at a very significant pace. So tens of thousands have been spent on acquiring customers, giving discounts, and building the scale and back-end infrastructure. So in general, if you're to make a conclusion, Meituan has stood its grounds until mid of August based on the current disclosures. Taobao was extremely successful, but JD has lost some of its gains in Q2 of this year. So it has been incredibly wasteful. They've been burning a lot of cash. The long-term effects are also questionable. So money could potentially be well spent more effectively into something more valuable and innovative. And it came on the back of regulators stepping in, trying to signal to the industry to tell them to stop a lot of all these anti-evolution behaviors. So that's on the competition and the demand front. What about the margin and how it's translated to their revenues? So from Meituan's discussion, even though the daily order volume is at record high, daily active users are growing at strength to strength. However, I think revenue growth significantly lagged behind their scale expansion, with their revenue only increasing 7.7% year-on-year for the core local commerce segment. And this is mainly due to a large portion of the incentive for the delivery service revenue. And on top of that, they did talk about the average order volume per orders actually dropping pretty significantly because of the dulling of all these subsidies. But I think on a year-on-year basis, the gross transaction volume still maintained the same pace of growth. And they wanted to highlight that the core user engagement matrix across both businesses have also showed sustained improvement this quarter. So they wanted to paint the story that yes, competition is steep, they're giving out a lot of subsidies, the general order volume is also decreasing, but transaction volume is still increasing at a very decent pace, and engagement metrics are also still relatively higher to kind of justify their spend, and they're doing it quote-unquote better than their competitors. So moving on to their long-term projections, I know many investors are concerned about the short term, but this is probably one of their last-ditch efforts trying to still retain investors to be optimistic about the future. So some perspective that they wish to share is that in the past year or two, in several quarters, they actually proved that they can do at least a renminbi $1 profit per order per day. So based on that benchmark, it's reasonable for them to expect a 3% profit margin because their average order value is around 30 RMB per order, and a $1 RMB profit is about 3%. And on that same note, they tried to telegraph out into the future of how their profits will look like. So they not only reached their 100 million daily orders, which was their 10-year target 10 years ago, but in fact, they significantly surpassed that recently by reaching 150 million daily orders. orders. But of course, not forgetting the backdrop that this is heavily subsidized and the entire industry itself is going through some very significant adoption and transformation. So they were not able to get that $1 RMB profit per order. And clearly, it's kind of reflected in their operating profits as well. So this is the two different stages of their long-term target. But in general, I think the long and short of it that they want to signal to investors is that they think they can achieve that 150 million daily order. They are able to earn 1 RMB per order per day. So you can do your own calculations of $150 million in RMB profit times 365 days. That could serve as some sort of a North Star. But at the same time, they do see a huge amount of volatility during this competitive landscape on the average order volume. So from that perspective, that will hurt the profit margin. But I think in the longer term, if they are able to rationalize this competitive landscape, and that is the end game, at least from the management's perspective. So the most concerning and recurring theme for existing investors is that they expect competition to continue for the short term, and they expect significant losses for both food delivery and their core local commerce segment in Q3, and hence possibly the very, very negative reaction from the market by selling down the stock first and to think later. So in general, Meituan really cannot give any sort of commitment because they have no visibility on how long this entire war will stop with Alibaba and JD as well. What's the takeaway from this recent earnings? I think by now, every mother-son knows that there's a huge amount of headwinds for Meituan, from delayed profitability to the irrationality, subsidy war with no deadline, questionable growth assumptions, and the sustainability or the new value created from all these acquisitions. So for existing investors or traders, I would potentially guess that it might be dead money for some time, unless things start to stabilize. But that said, I think there are still a few big themes that we cannot deny today. First, I think food delivery is not going away anytime soon. And in fact, Meituan being the dominant player in this industry, as long as this trend continues, it will still be a huge tailwind for Meituan's main business arm. But I think the worry here is really we're just not too sure whether profits will stay or how long would it take for it to come back. So the base case here, at least from my view, is that the market is big enough for a duopoly for both Meituan and Alibaba to operate and compete in. So the instant shopping as a category will also mature at a very significant pace, given the investment and exposure coming from both Alibaba and Meituan, trying to adapt or trying to build the habit for current existing consumers. But a very big but here is that given the current involution and the market share obsession from these two large companies, we really don't know when and how they will stop, especially under what conditions. And specifically in this case, because we don't have an end goal in mind and we don't have any so-called deal breakers or red flags to be conditioned to look out for, especially because of Alibaba, and I treat them as the quote-unquote game master here, as long as they don't call it quits, I think it's very hard for Meituan to stop. Since, in this case for Alibaba, they have the largest scale, they have the deepest pocket, and if they wish to continue screwing Meituan, they can, which will ultimately be a lose-lose. So investors on the aggregate are probably waiting on the sidelines, waiting for some sort of a cue from these companies that competition is stabilizing, or they've seen great progress and investments will be halted. Till then, I think it's anybody's guess on when this will end. And mine is until at least early 2026. So I believe that there's a very interesting conundrum or dynamics that is in play here. I think first things first, I'm totally not looking at JD.com at all. I think the odds are stacked heavily against them. They have not been seen performing at a very high level, especially when coming from such a weak base. Second, I think we have that crown prince here with the king's backing. So although this Crown Prince, which is Alibaba, he has misplayed for a couple of times and they don't necessarily have a very good track record of executing, but I think all things considered, he's still considered the prince. And thirdly, of course, we have the incumbent, the workaholic, the executioner, the hungry one with a phenomenal track record. So how far are they willing to take things to? I think that's the million-dollar question. If you're able to triangulate and try to guess when it's going to stop, by buying right before that moment, you'll probably make a lot of money. So the last part for myself, maybe to offer some coping mechanism, especially for existing investors, is that first things first, I think food delivery as a business industry is extremely low margin and also requires a lot of care and optimization. So I don't believe that it's really something Alibaba would fight all the way till the end, unless they have something to prove and they have some chip on their shoulder. But I really do like to believe that Alibaba as a management are good stewards of shareholder capital and they know when to stop. So I do reiterate my position that they're building scale and habit and will pull back after thinking that they have made good headway and not go all the way. Secondly, I think for Alibaba specifically, they should be kind of distracted by AI and cloud today. So they still need to spend another 280 billion RMB on cloud, even though they pledged only 50 billion on this consumption pie. So specifically for this food delivery business, I think they will need insane amount of justification and to show great numbers to justify the opportunity cost of their capital. If not, a lot of all this money could better be plowed back into AI and cloud. So this is the ongoing consideration for the management team at Alibaba. But I think there's a very big but here is that with the instant commerce in the picture, especially after listening to their most recent earnings call, I'm getting a little bit shaky on this because they seem to just keep pushing the button to show investors that actually this is working and it's helping the other parts of their business properties as well. So I think I'm kind of half-half on this. And the third part is really, especially in this very intensive competitive dynamic, execution becomes a big differentiator. And of course, if history do serve as any guide, this is considered round 2 between Meituan versus Alibaba. How would it play out? I really don't know because there's a new management over at Alibaba today. But Meituan, even in their own disclosure, is saying that they're currently the underdog and they're willing to fight it all out. And to put all of these together, I think Meituan still have a very good fighting chance. And like I said, I think the market is big enough for a duopoly. And like any industry, I don't believe a company is able to maintain 80-90% market share for an extended period of time. So if you have stayed till the end and you would like more of my opinions on Meituan, I believe by the time this video is uploaded, I would have also uploaded a members only video to share a little bit more about how I look at Meituan's valuations today, my own personal deployment plan around this investment idea, and also some additional thoughts around them. So if you're interested, you can join the newly created YouTube membership with the join button below, where I'll be sharing more unfiltered members only videos, at least on a fortnightly basis. So with that in mind, I'll see you in the next video, but more importantly and hopefully, I'll finally see you guys on the moon. Goodbye.